Welcome back to the Data Driven Real Estate Podcast. This is episode 16, and this week we've got Dave Savage. He is founder of The Mortgage Coach, and he has over 27 years of experience as a mortgage executive, business leader, and mobile technology pioneer. This week we talk about trends and disruption in the mortgage space, the prediction about mortgages starting with a 1%, which you definitely won't want to miss, moving beyond the transaction and really working on building relationships, lifelong clients, and how that's possible in the mortgage space, which is increasingly important, and how mortgage pros are leveraging technology in their business, all on this week's show. You won't want to miss it. Hey, welcome to the Data Driven Real Estate Podcast, the podcast for real estate professionals dedicated to driving business using data. I'm Aaron Norris with co-host Sean O'Toole with Property Radar, and today we have Dave Savage, founder of The Mortgage Coach. Hey, Dave, how's it going?
It's going good. Good to be here.
So tell us about your foray into the mortgage industry.
God, I got in the mortgage business over 30 years ago and was a loan officer for many years, and just figured out a better way to deliver mortgage options to family. I turned borrower education into a competitive advantage and founded Mortgage Coach over 20 years ago. Back in 2000, I decided to be a full-time technology entrepreneur, and today I am the founder and CEO of Mortgage Coach that helps loan officers turn borrower education into a competitive advantage.
And we've known each other for a while, Dave, and you're a multiple entrepreneur as well. You've had mobile communications companies and other stuff too, and you've always struck me as a data-driven guy. So thanks for joining us.
No doubt, Sean. So Sean, we're entrepreneur buddies, and you and I were close during the Smart Reply days. That was a company I sold, I don't know, it's been over 6 years now. It's been a long time. Yeah. And we've both seen each other go through building companies, selling companies, reinventing companies. So it's good to be here with you, brother.
All right. Thanks for coming.
Tell us a little bit more about Mortgage Coach. What do you do? Who are your clients?
So I am super proud to say that 34% of loan officers that do over 100 loans a year use Mortgage Coach. So we've got a lot of very high producing loan officers that use our product. We got a lot of brand new loan officers that use our product. We've got 7 of the largest non-bank owned lenders that have our product built into their technology platform and their culture. So we've got a lot of top producers using our product. But I think what I'm proud about is anytime a local referral-based mortgage professional is servicing a family, they're just delivering a higher quality of service and value. When most people get into mortgage debt, the data that they get is, here's your rate, here's your payment, and here's your cash to close. And I call that the transactional triangle. Those are the 3 pieces of data that they get when they get into mortgage debt. And loan officers compete on that. I've got lower rates. I've got lower cost. I've got no points. I've got no cost. And at the end of the day, they're just selling money. And it has become a commodity. And at Mortgage Coach, we believe that when someone gets into debt, we need a few more data points. Like, I believe that when someone gets into debt, they need options. So don't just look at one mortgage program, look at multiple mortgage programs. So that's a data point. And then I believe in our whole business model is built around, you need to look at those costs and those options over time. Like, what's the total cost over time? If you're paying points and you have this rate, and you're not paying points and you have this rate, and you think you're going to be in the house for 3 years or 7 years, what's the total cost over 3 to 7 years? And so you're just looking at things deeper and over time. And then one last data point that's a foundation to the Mortgage Coach way of doing things is that let's say you're refinancing your home. You should compare your current loan versus the refi over the time that you're likely to have it, and the time that you want to retire or the time that you want to be debt-free. And then you should always look at strategies to build wealth with real estate. So what if you took that monthly savings that you're getting in the refi and you prepaid your mortgage? How much interest could you save and how many years faster could you pay it off? Or what if you took that savings and you invested it with your financial planner based off of your return on investment? What would you look at? So our model is just taking a few more data points beyond the typical transaction experience, transactional triangle, rate, payment, cash to close, and then making that easy. So like a loan officer can, within a matter of a couple minutes, not 10 minutes, like 2 to 3 minutes, build like a beautiful presentation give it to a family, and then that family who has, they're not financial planners, they don't have any experience, they can consume that content, So that's what we do. We make it easy to deliver, help families make confident decisions, and with a little more data.
That's interesting. So you're almost
That's your core project, and it's like an advice engine, like maybe as a.
Oh, by the way,
way to put it.
did you know that we call it the advice engine, or did you just make that up?
It made sense. It would be an
Yeah,
advice engine.
we call it
That's perfect.
the borrower experience. We call the total cost analysis, although a lot of lenders will come up with their own names for it. And then
Right.
what creates the total cost analysis, we call the advice engine.
Advice engine, great. So is that the core product? Are there other products too? I mean, you still do coaching as well? At least you are very prolific in terms of the content you produce and stuff for your folks.
Yeah, no doubt. Well, we have another app called RateWatch, and RateWatch monitors mortgage-backed securities, puts context around it. It's an app. You can go to the App Store, download it. To use it, you need to be a Mortgage Coach member. We do have some partnerships where we make that available to everybody that uses Optimal Blue. For instance, if you have Optimal Blue and you're a loan officer, you can use the RateWatch app. In terms of coaching, I think calling it a value add is understating what it is. But, I learned back in the meltdown, the 2007, 2008 meltdown, which you and I both experienced firsthand. You kind of rode that wave. I mean, it was, you built quite a model around that. So Sean, you took it and turned it into a positive. I lost a lot of my customers through that, and I found out who used our product. And so, I mean, I was always a passionate educator. I mean, I named the company Mortgage Coach because I'm turning loan officers into mortgage coaches. I'm turning them into mortgage coaches. So there's always been a training element behind that. But coming out of that meltdown and finding out who uses our product, who doesn't use our product, I started doing a coaching call every Tuesday at 9:00. And my vision on that was there's not a lot of sales meetings taking place in the industry. There's not a lot of leadership and training taking place. And I'm going to put on the best sales meeting and the best training experience every Tuesday at 9:00. So I started creating content. Back in the day, we weren't using Zoom. We were using GoToMeeting. GoToMeeting didn't evolve very much, and Zoom did. So we switched to Zoom. But what's that?
Is it just like us? Did the same thing?
Yeah, so we're on Zoom. You're streaming this in podcast.
And those
so I started
Tuesday
creating
calls,
content.
Those
Excuse
Tuesday
me?
calls, those are free. Those are open.
They're
right?
free. They're on our YouTube channel. And I am super proud of our YouTube channel today. We've got over 11,000 subscribers. We get hundreds of thousands, actually over 1 million minutes, several million minutes a year of loan officers consuming content on that YouTube channel. So it's gone from every Tuesday at 9:00, which I still do today, 10 or 12 years later. And then I also, as CEO of Mortgage Coach, I try to at least a couple times a week do a 1 hour interview, or not a 1 hour, half-hour interview with loan officers. So I'm just staying close to the trenches, but I'm not like a coach. I don't do fee coaching. I turn you into a mortgage coach. Our platform does. And then we create content through our YouTube channel. And then we have a Facebook group too that is free to the industry. If you're a mortgage or real estate professional, you can, check out our YouTube channel and check out our Facebook group.
Yeah, I mean, that was something we had in common, because I think most people in this industry try to monetize the coaching, the training, and that kind of thing. And I think both you and I have, through the foreclosure crisis, we trained thousands of people, how to do short sales, how to do buy foreclosures at auction, and how to buy pre-foreclosures, but all that was free. And you took a very similar approach. I think that's great. So.
Yeah, I think when you're going to take the time to create that content, you want to just get as many eyeballs on it, as much attention, as much change. It's served our business well. And so, yeah, we don't sell coaching, but we do every single day of the week. If you're part of the Mortgage Coach, there's live training, there's live content, and we're teaching and we're training. And in the sales process, when we have a company that we're trying to say, hey, buy our technology for all your loan officers, they look at it as, hey, I'm getting, like a VP of sales training. in addition to a piece of technology. So it's just how we've run our model.
So what are your folks seeing out there in the market right now? What's going on for, the independent mortgage broker, all the folks that you help out there? What are they seeing in the market today? What are their challenges?
Just keep it up. They're killing it. They're overwhelmed with production. The amount of volume that we're going to do this year as an industry is an amount of volume that we didn't even know that we could do. One interesting trend I'm seeing is that the top producers that are good leaders, that are using technology efficiently, they use their CRM, they use video, they use Mortgage Coach, they use Zoom, they're just killing it. I mean, they've already closed more loans this year right now than they did all of last year. So just breaking records by, significant margins. And the biggest challenge.
None of them thought that was going to be the case in March, April.
No, absolutely not. Yeah, no. So it's been really good. I think, the biggest challenge is just how do we get more hours out of the day? How do we be more efficient with our workflows, with our time? It's been a boom for Mortgage Coach because we're selling a virtual digital mortgage platform to deliver advice. So it's been a boom for us. And then I think they're, how do we not burn out our team? How do we not get burned out?
Right.
So I think it's been a very exciting time. There's been a lot of silver linings in this COVID times for Mortgage Coach and for families. I mean, heck, that's the other thing. The mortgage industry is lowering people's payments. Every refi is creating fiscal stimulus for a family. And also you're seeing a lot of move-ups. A really common strategy that you're seeing in the Mortgage Coach community right now is a refi versus move up, where a family will okay, column A is my current loan, column B is refi, I could save $322 a month. Column C is I could move up, get another room. A lot of people have equity. So there's a story, an interview I did with Amber Kovarik out of Chandler, Arizona, and column 2 was refi, column 3 was move up, and they had equity. So they qualified for a 5% down loan and they had equity. Column 4 was, hey, buy that new move up home, non-contingent, and then take your equity. They had $125,000 equity and recast your loan, and their payment would have gone down by $126,000. So, and then what the family ended up doing is saying, I'm going to do column 3, where I do move up, non-contingent, and when I sell my home, I take that money and I put it in the bank, and based off of my return on investment, they've literally increased their net worth by 30%, and they've increased their liquidity, in the bank by 50% because they got $125,000 in an interest-bearing account. So you're seeing a lot of refis, a lot of move-ups, and you're seeing a lot of first-time home buyers come into the market too.
Yeah. So is it pretty for the average mortgage? Is it pretty even between purchase and refi?
No, I mean the refis are. I could actually pull up some data while we're talking. I'm going to multitask a little bit, and tell you what it is because I got my hands on some data. You might have this too. So if I'm stealing any thunder from your platform, feel free to share the stats. But I am, there's definitely a lot of, call it the distributed retail model, referral-based local mortgage professionals. They're doing a lot of refis right now. So let's see what we got here. Total volume. By the way, do you have any of these numbers?
Well, we certainly track, how many mortgages are created and purchased versus cash out versus, rate and term refi, that kind of stuff. So yeah, that's all available on our platform.
Yeah. So I'm looking at just top lenders, and, Quicken is, done 672,000 refis compared to 94,000 purchases. Loan Depot, one of our big platforms, has done 31,000 purchases compared to 142,000 refis. Fairway, our biggest refis. What's that?
Yeah, it's about 5x refis.
Yeah, well, Fairway, our biggest client, the Mortgage Coach, has done 77,000 what is that, purchases and 85,000 refis. And I think that is probably, guaranteed rate has done 44,000 purchases compared to 77,000 refis. And I'm looking like the distributed retail model looks like definitely anywhere from 20 to 2x refis. And then when you get into like, let's call it the household name Wells, they've done 77,000 purchases compared to 169,000 refis. So, it depends on the model.
Yeah, on their business model.
Yeah.
Aaron, are you back?
I don't think so.
By the way, B of A is
Push your volume up,
39,000.
seems like. Wow.
And if I
So the other, one of the big stories, like when the crisis kind of first occurred, and I don't know how much you know about this or not, was the independent mortgage banks and having a liquidity, kind of crush. Did you follow that? That's something that really kicked the whole crisis up another level, and like lending disappearing and that kind of stuff. So early on,
It
there
was
a lot of
scary.
fear about that.
There was some very tenuous weeks coming into, you're talking about when COVID first came in and forbearance was announced and, the liquidity crisis, the capital calls. That's what you're referring to, right?
Yeah, because so I don't think a lot of people. Everybody thinks like the bank is the lender, right? And the loan's made, and then but there's the servicing rights, and so there's a person who collects the payment and then pass it along to the underlying security that is actually the lender, and that might be a retirement fund that's in that. It could be the Fed.
It was scary. I mean, you had two things happening. You had a devaluation of portfolios because rates went down. So like the portfolios are going to run off, devaluation. You had forbearance come out, an announcement from the president that, there's this forbearance, but there was no like, okay, how are we going to help these lenders? Like people aren't going to be making their payments. So there was a period of time where they didn't know.
Let me finish explaining that for the folks at home. So the way the servicing works is you send your payment to the servicer, and then the servicer takes their fee and they pass that along to the underlying security, right? Whoever the lender is down below. The way those agreements work is if you don't send your payment for any reason, that servicer still has to make the underlying payment. So when they announce forbearance, right, you could potentially have a huge number of folks stop making their payments to the servicers, but the servicers are still responsible for making the payment. Of course, they don't have the cash to do that. So at the time, it was like all these independent mortgage banks, these servicers, they don't have the liquidity. They're going to go broke. Is that a good summary, Dave?
That's absolutely a good summary. Yeah. There were just capital calls, regional, very successful big players were having to make capital calls. There was a lot of issues. There was a lot of fear. Fortunately, we made it to the other side of it, and now everybody has done a lot of volume, built up balance sheets.
First, rates kind of went up because of that, right? And credit tightened and rates went up. That was kind of the initial reaction, right?
Yeah, I mean, rates were going down. I mean, net rates were going down, and that was part of what was causing the capital calls. People didn't have credit lines, but net rates are at absolutely historical levels. I could pull up my Rate Watch app and see how close they are to the bottom as of today when we're doing this. But there was no doubt that it was a tenuous few weeks where at first we were all going, yeah, refis, we're killing it. Mortgage Coach was, while COVID is scary from a health perspective, we were not getting put out of work. We're super lucky that we had jobs. We thought we were going to be shielded from this financially. And then there was a period where implodometer, are we going to start seeing companies, shut down? And I'm going to see companies, important clients of mine, not paying, and then we made it through it, and it's been good for the mortgage and real estate industry.
Can you hear me now?
We can. Hey, welcome back.
Welcome back, my friend.
It's strange. Nothing changed on my end. It just decided to stop working through the connection. So there you go. Opendoor is about to do its IPO, and it's very clear that a lot of these iBuyers are incorporating mortgage as a key piece to the linchpin. So they don't have to make money in one particular area. They're making money in an ecosystem that they're creating. Is that a big conversation inside the mortgage industry and a concern?
Well, it's not a big conversation today because we're overwhelmed. We have more business than we know what to do with. But call it this COVID crisis and this low interest rate tidal wave. And I think it will be a big topic coming soon, which was the disruption of the mortgage space and the fear. Like when I spoke at the Digital Mortgage Conference, not this year, but last year, and it was a massive topic. It wasn't a question of if Amazon's getting in the mortgage space, it was how and when is Amazon getting in the mortgage space. And it wasn't a question of is Opendoor and Zillow and these disruptors gonna completely disrupt the mortgage space. It was a question of when and how. And I think it's not at all a conversation in today's market, but I think as rates start to tip up and we get into a more normal market, it's going to be a big deal. Like right now, Quicken went public. A number of other companies have put it out there that they're going to go public. So you're starting to see large mortgage platforms go public. You're seeing disruptors like Opendoor. We have the consumer. How do we make everything around it? Zillow is definitely expanding their mortgage services. And so, yeah, it's a big topic, and it's going to reshape the industry in the coming years without question.
I think what I like about what you said, though, is that you're sort of providing a bridge between mortgage and financial help, where it doesn't seem a lot like a lot of these lenders are going to be very focused on that kind of customer service. Do you think that will be the case?
No. I mean, there's some, every lender that is investing in a mortgage coach and building this into their tech stack and building this into their culture, they're doing that because they get it. Their loan officers need to provide value beyond the transaction. That rate, payment, cash to close, and the submitting of an app, and if it's auto approved, they get it that like if it can be automated, it will be automated. And that type of transaction is going to become commoditized. And if you're a referral-based local mortgage professional, they know their loan officers need to become advisors that deliver value beyond the transaction. So now that is not the majority of the business. While we're picking up market share, and we have 7 of the top 10 non-bank lenders investing in Mortgage Coach, but a lot of them get it. They need to turn their loan officers into advisors, and that's a combination of technology and training. They need to go from transaction salespeople to solution salespeople. But a lot of people are doing it. I mean, it's a big movement. People that aren't, I think they're in for a rude awakening as we get on the other side of this mortgage revolution that's taking place.
Dave, because you work with all these groups, like one of the things that's always like, I don't know, I find an interesting question, like what is the, you've got the independent, you got the brokers, right? Like that could be even independent, could be one guy just hanging out a shingle, right? And then
which are picking up steam. I mean, that model is thriving.
Okay. And then you've got like regional players, then you've got the independent mortgage banks, you've got the larger, like the Quickens, the online. Break the industry down for us. What are the key groups and maybe the pluses and minuses of each of those, styles, entities, organizations, whatever the right way to put that is? Like, because it's just never been clear to me.
Yeah, no problem. So big banks. I don't think I need to describe that a lot, other than maybe the benefit is that it's my bank. I know them, I trust them, and it's a big bank. So there's some security and trust built into the brand there. There's online lenders. Quicken is the biggest name in online lenders that they're great marketers, and they run consistent processes, and they train their people, and they deliver a great, well, I don't know if it's great, but they deliver Quicken delivers a great customer experience. You've got
factory, though, right? I mean, it's a factory floor, big call centers, that kind of thing.
Yeah, but they deliver. They're delivering a consistent consumer experience. You've got credit unions and community lenders, which credit unions are they're not for profit. They're for their members. but they don't have the technology. But you have the relationship, and you have someone that you can trust. And I actually don't know what percentage of the market they are, but they're still a real portion of the market. You have
Like
brokers.
play a
Go
lot on
ahead.
the commercial side too.
Yeah,
Right.
no doubt.
Do they play much in the housing side? A little?
Yeah, no, we've got a couple of the largest credit unions in the country as clients of ours. First Tech is our biggest credit union client, and they're killing it. They're low price leaders, and they're community players. They have a brand loyalty if you're part of that credit union. And I think there's a type of consumer that is attracted to that. You've got brokers, which are scaling and growing, where it's just independent loan officers. Could be a one-man shop, could be a 10-man shop. You're starting to see some kind of mega brokers coming up. The second largest one is a client of ours. But that model is scaling. Distributed retail, though, the Fairways, the Calibers, the Loan Depots, Prime Lending, some of our biggest clients, Finance of America, Guild Mortgage. Anyways, the list goes on. That's still, I think, the biggest.
What would you call them again? Distributed?
Well, I think they're called independent mortgage bankers. So I think that would be the thing. I call them distributed retail, but independent mortgage bankers. That I have to think is the biggest volume. Although big banks do so much business, I really don't know the breakdown between the categories, but these are the categories in the models. And then I think there's a new model called the disruptors, the open doors. But you even, and I haven't done this slide for a while, but when I spoke at Digital Mortgage Conference, I actually broke down the industry in all the different categories. So I actually have a slide on that if you want to. I don't know if you could put it in, and I'll forward you a slide breaking down the industry. Because when I did the presentation, I went like, hey, last year, this was what it looked like. And this year, this is what it looks like. And because it used to be pretty much I was done, but now you have, Keller Williams is in the business in a big way. You have real estate owned mortgage companies in a big way. You have disruptors, which are the open doors in the space. You have the lead aggregators. Zillow is in the space. You have the threat that platforms like Amazon is in the space. So the number of categories in the mortgage space, and it's all been enabled through technology. It's all been enabled because now it's push a button, you apply for a loan with a link, family fills out that link, data comes from, countless sources, aggregates it, intelligence, qualifies them, approves them. And that's why you have all these new categories competing in the mortgage space. And it's quite disruptive.
So I get my NMLS, is that right? License, right? Now maybe I'm working for my local bank or something, right? I'm a salaried position, but I really like this business and I want to grow personally and, grow my business and grow my income. Like what's the path that I take from being like a junior loan person to like being a guy making 7 figures a year doing loans?
What I would tell someone is it's all about the quality of your service. You have to go beyond the transaction and deliver value beyond, I've got a competitive interest rate, I'll close your loan on time, and I keep my promises. So what? That's table stakes. And you need to deliver value beyond the transaction. And you need to build a database. And that database needs to go beyond being data in a CRM. It needs to be, I call it mortgages under management. People where you're saying, hey, I can close your loan on time with a competitive interest rate, but I'm going to help you build wealth with real estate because I'm going to give you a better level of value. And I'm going to manage that mortgage every month. Just like, you have a financial planner and you get a report every month telling you how your assets are returning. I'm going to do that with your real estate and with your mortgage. a very hot tech company. I think we're one of the hottest tech companies in the mortgage space, but another one's called HomeBot. And they do a great job because you put in a client's data and it's providing a lot of value. We integrate with them. But that type of value where I'm going to manage your mortgage, I'm going to manage your real estate, you got to provide value beyond the transaction. That's one of the reasons I'm excited about being on your podcast and learning more about your next gen product, because I have a feeling that you're going to be one of those hot platforms that anybody in housing is going to benefit from.
You've long talked about how important being hyperlocal is for the mortgage folks, and it's not a term. It's a term we've used and we like a lot because it's something we believe in and we think public records helps people do. But tell us what hyperlocal means to you and why that kind of stood out for you and why you think it's important for mortgage folks.
Well, I have taken my hyperlocal rant and really focused on hyper personalization. So when I do a lot of my coaching calls and training, I talk about, hey, there's this content that's generic, it's global, it's macro, and there's a lot of data sources, a lot of news. And so I used to always talk about, hey, your job as a loan officer is to localize that. Or if you're a loan realtor, how do we take that and we localize that? And realtors crush it at that. I mean, that's what they do, is they're like, hey, I know this neighborhood better than anybody, hyper-local expert. And that still works. But what works best is when you hyper-local and you hyper-personalize. And so I do a lot of teaching on that. Just like that move-up analysis. You could take hey, here's some macroeconomic stats in America on equity. We all know that rates are at a historical low. We know equity is at a historical high. We know consumer debt is historically high, macro. So I would teach a loan officer, know what that means in your city. What's the equity? What's the debt? Rates are the same nationally. And now what's that mean personally? Like, come to a realtor who says, hey, you've got these hundreds of families that you've sold homes to. Now, how do we do a personalized move-up analysis for them? And we'll personalize it. So it's hyper-local, hyper-personal. And I do think that is how both real estate and mortgage professionals who want to be referral-based professionals, how they will exist in the future world. Like, without real, tangible, hyper-local content, hyper-personal value, you're going to get disrupted by the machine.
Yeah, that's definitely our primary thesis to our customers, right? Like, the good news about being local, right, is you can do things that don't scale, and you can take that next step that the big boys just can't do at a large scale. Even like the realtor who has that, they know their subdivision, but not everybody in that subdivision is the same. Some have equity, some don't. Some are older, some are younger. Some have lived there a long time. Some have only lived there a little bit. And you can tailor that message to each of those groups, but you need a tool for separating them out. And that's definitely what we've brought to market. So we're excited about that. And
can't wait to see it. Can't wait to hear about it. And I'm fired up. Forgive me if I'm looking over here on my screen. I was looking for that slide that I have that shows the different markets. I just found it, and I just wanted to make sure that I wasn't missing any categories. But it looks like I got them.
Digging into that.
Well, fintech. I missed two categories. Fintech. So you're looking at Mosaic, SoFi, GreenSky. And then you're also seeing the investment bankers and wealth managers like Saks and Merrill Lynch go direct. So, like, I've got one slide that shows 1, 2, 3, 4, 5 categories. And then I got another slide that shows, I'm not going to count them, but it's over 15. And it happened in a single year. It actually happened in about 6 months. When you think of when Keller went direct and Zillow went direct and Open Door and OfferPad started going, it just like the world changed.
Can we explore inside that and look at the demographics? Are there any of these categories, are they specializing in specific demographics, especially for millennials and the Gen Z, who early data shows that they want to get into real estate earlier? Are you seeing any players win out of these
So I'll
players?
speak to that. I didn't ask your permission to share my desktop, but
Oh, that's fine. That's great.
Beg for forgiveness.
Saves me
But-
editing
but,
later.
Yeah, right. But like, so this is what it used to look like, less than 2 years ago, probably 18 months ago. And this is what it looks like today. The battlefield for the consumer's mind has changed. And so I already kind of described this in detail, but yeah, no, there's definitely, I think, different factors. Like when you look at the wealth management crew that's getting in here, yeah, they're going after the affluent, they're going direct, but they have a customer base. So the commonality is I
Yeah.
have a customer base.
Mm.
Now that I have automation, how can I quickly and easily do a mortgage with that customer base? You look at Zillow, they're coming in, they're saying, hey, we got a customer base and we have a consumer share. How do we do a mortgage for that, folks? So you're seeing that across the board in terms of like, retail mortgage lenders. They're still like, it's all about having an army of referral-based local professionals, which are the majority of our clients. I mean, we empower them. We turn them into, take them from a loan officer and turn them into a mortgage advisor. But yeah, I think that's the common theme when you look at all of these. You look at the credit unions. They've got a mind share and a consumer, and mortgage is just another spoke on the wheel.
You have a very interesting category. Now, Amazon, I think it was a little bit over a year ago, announced their turnkey program partnership with Realogy. And we haven't heard about it because rumor is that it hasn't gone well. And that they give away, if you use one of the Realogy brands, you get so many dollars worth of free stuff from Amazon. And the problem was that their home services sector wasn't being able to install and perform. So any thoughts on the Googles and Amazons of the world if they're going to be able to compete with the people already in the space?
Yeah, they'll figure it out. I think it's when and how, and it's not as easy as they think. Everybody that comes in the mortgage space, it's never as easy as they think. But with data and artificial intelligence and the way the world's evolving, they will figure it out. But I
They can throw
personally
money
believe,
at it forever.
Right.
yeah, and they'll try. So there's a lot of mistakes ahead, but it will be figured out. But I just think if you're a local referral-based professional and you're a local expert and you know how to deliver personal value beyond the transaction, I don't know. I mean, maybe forever. You've got a good job. So I kind of coming back and wrapping a bow around that question on what advice do I give to new loan officers? It's all about like 1,000 should be your goal. 1,000 families where you manage their mortgage and you have tangible advice that helps them save money more effectively. It helps make them better mortgage and financial decisions more effectively. Most people retire with less than $100,000 in the bank, but because most people, when it comes to making liability and debt decisions, they misconsume several $100,000 in debt over the course of a lifetime. So I think if you can be that advisor, and it's tools and it's knowledge, and it's also just caring about people beyond the transaction,
Listening.
for sure, you got 20 years ahead. But I don't know if you'll ever lose that, because I think as long as we're humans, we like humans and we like stories and we like people that can add value. So I don't know. I think maybe you'll always be good, but you just can't be a transaction coordinator and an app taker. That's not going to cut it in the world ahead.
Right. In which of these, different groups, like if you're an individual, like you're probably going to end up being a mortgage broker, right? Because you're going to make a salary inside of a Quicken or inside of a Zillow or one of those, most of those places, right? Like is it really only going independent that you get good?
No. I mean, the distributed retail does incredibly well. Most of the top producers are in the distributed retail. And I think that model is solid because, when you're a broker, you have to manage more than just I'm a loan officer and scale. Now I think the broker model is great. And I know some big brokers that do a lot of loans, and the companies that service them have improved their automation. So the ability for a broker to execute both great price, options, and execute, I mean, it's incredible now. So the broker model is going to thrive and it's going to grow. But I think the distributed retail model is too, like, hey, I want to wear a uniform. I want to be part of a team. And I just want to focus on doing volume. I mean, that's, there is this movement in the mortgage space. Brokers are better. And, by the way, that's the brokers that are saying that. I'm like, guys, they're all great models. We're a lot of different human beings. For some people, credit unions are better. For some people, big banks are better. For some people, Quicken is better. Like what I tell new loan officers is pick a strategy. But yeah, you personally need to be a local expert. You need to be a personalization expert. You need to be a mortgage coach, and then just take care of your families. And it doesn't matter what model you're gonna make a great living. You're gonna kill it. And this business is, I think, mortgage industry is the best industry, one of the best industries in America to get into right now, because you got a lot of independence, and they're doing a lot of business, and it's not going to slow down in the next couple of years, in my opinion.
Well, let's talk about rates. Earlier you said it, when rates start going back up. My personal thesis is we have so much debt, rates can never go up. They can really only go down from here. I think 5 years from now, what was it, 4 or 5 years ago, Aaron's dad, Bruce Norris, and I both at about the same time predicted we'd have mortgage rates in the 2s at the next crisis, which appears to have played out. And I am now going to go on record as to saying we will have mortgage rates in the 1s at the next crisis, because there's always a next crisis.
Yeah, well, I'm not an interest rate predictor, but I have a chief economist at Mortgage Coach. His name is Dan Rawich. Dan is amazing. He's got a platform called Market Mentors. For over 10 years, he has done a daily video on the Mortgage Coach channel, and he agrees with you. He thinks rates are going in the 1s, and he was saying rates were going in the 2s, and he was right. And so, but I'm not. All I'm doing is parroting Dan, because he's my guy, and what he says in the Rate Watch. And I'm not the CNN watcher. I'm not the one that studies those numbers. I was once upon a time, but I'm so ADD. I've got to pick what I study and study numbers. But Dan Rawich agrees with you, and I believe whatever Dan says.
Now,
So
FHA.
back to your.
By the way, you guys should have Dan on this show. He would be incredible. He's just an oracle of data and insight. He'd be a really good guest for you guys.
Awesome.
FHA surprised us with this risk premium that they put on hold, but it's supposed to go back into play later this year. I have a feeling that's not going to come back, because you brought up earlier, when somebody gets to refi at a lower rate, that's money they actually get to pocket. Are you hearing anything on the streets that that's going to come back for sure?
I hear lots of different stuff. That, again, not an area of my expertise, so I'm really going to just not even comment on that, because I don't have the insider information. Everything I hear is just people I follow, and I hear a lot of mixed messages on that. I do know our industry doesn't like it, so I know.
Yeah,
and I do know if I owned a mortgage company or I was a loan officer, I don't like that. Yeah, and they're my customers, so I don't want it either. But if
Well, if Dan and I are right about rates headed to the 1s, like the outlook for the mortgage business really is pretty darn good, right? Like, because as rates can continue to go up, people refi. It's just
because that's only going to raise the rate by an 1/8 to 3/8, or quarter, whatever. So I don't know. I'm not going to comment on it, because I just don't know enough about it.
No, I was coming back more to the trend of rates overall. If the trend of rates towards the 1s, that's incredibly bullish for the mortgage industry.
You think? Yeah. I mean, it improves affordability. Rents have gone up, so first-time home buyers, between COVID, it's makes renting even less desirable. Appreciation rates with homes are going to go up. So yeah, the fundamentals for housing are incredibly good. It's hard to come up with a scenario that says that mortgage, real estate, housing is, one, going to lead us out of this recession, and two, has 3 great years ahead. But again, I am not an economist. I am not studying that. That is not my opinion. That is the opinion of people that I listen to and believe in.
Let's talk about right. You got to have I guess there's a national license, but there's also state licensing, right? So mortgage brokers or licensed in their state, we're seeing more people move and change states. So that 1,000 families, right? Now you're starting to see some of those families leave and go to another state and really can't serve them anymore, right? Is that kind of churn a problem for folks that go after those families?
Well, no, I think the mobility, I'm finding loan officers that are moving, they've got a lot of, huge business, making a fortune living in one city that say, you know what, for lifestyle reasons, for family and where I want to live, I'm moving to a different state, and they're still able to keep that business. And so you're seeing lenders have multiple states. Yeah, you're seeing lenders have multiple states that can move. I've got one of the top producers in the city of Chicago is a customer. And part of her model is, yeah, she kills it. And she's one of the iconic lenders if you're buying a house in Chicago, but a lot of her clients are moving out of Chicago. And so she, is with a lender that lends in all states, and she follows them. So I think a lender's ability to follow the customer, and then a lender's ability to work with it wherever they want from a lifestyle perspective, it's scaling. It's a movement. It's not, the migration is not hurting the opportunity for lenders.
Yeah, and I guess, with COVID, right? Like this whole thing of like come into the office and fill out the paper, or come in, to read, all that's gone. So you can do this business from anywhere.
Yeah, no, I interviewed the best loan officers in America, and it was surprising pre-COVID how many top producers still met a good percentage of their clients in person. Like iconic loan officers are doing the most volume of video loan officer in the country. 30, 50, 60% of our clients were coming in. I've interviewed those people post-COVID. Obviously, people aren't coming in, and they're saying, I like it better. My conversion is still great. The amount of time that I have to spend with the family is less. I'm getting just as deep in less time. And I do think post-COVID times, there will be this kind of like preference management, as text, text, email, video, and now we have virtual or Zoom. And now it's just going to be like, hey, how do you want to do it? You want to come to my office? You want to jump on Zoom, or you want to take care of this over the phone call? Preference management and Zoom/virtual connection is not going away. It's going to be just depending on what the interaction is, how much advice is there, personalities, how close we are, convenience, but virtual is here to stay, in my opinion. Grandma knows what Zoom is now. Grandma likes Zoom. So it's not going away.
We talk a little bit about marketing. The finance industry spends a lot of money on marketing. Has any of that changed in the last 5 years, say, on what mortgage brokers are spending their money on to get clients?
It's all over the place. I mean, obviously marketing works. Quicken has proven that out, and it's the numbers game, so you were seeing a lot of Facebook marketing. Now, I shouldn't say we are seeing a lot of social media spending, although from what I've heard over the past couple of months, it seems like Facebook is harder to do than it was a year ago per se. But yeah, social media spending, big platforms like LendingTree and Bankrate, they're a thing. Zillow is still generating the majority of their money through advertising and people buying leads. Yeah, so those models aren't going away. I don't know exactly like how does it compare today, pre-COVID versus post-COVID. I don't know. I'll bet that it's gone up just because transactions have gone up. But in terms of I don't know how it's trending, other than macro. Like over the past 5 years, it's growing. Like that's pretty obvious. Marketing works. Spending money for leads, it works. It's a thing.
Getting more competitive though, I imagine, right? Like that cost to reach that customer, acquire that customer is probably going up too every year. You have all these new players.
Absolutely. Absolutely. But you're seeing new things, when you look at the social media platforms, I don't follow Gary Vee a lot, but every once in a while he puts something out that I see and I like. And he said that LinkedIn today is like Facebook in 2012. And I use LinkedIn to communicate, engage my audience of mortgage professionals to grow my business. And it's very effective. And it's very efficient. So you're just seeing platforms come and go. But, like I think Instagram has massively grown as a legit platform of influence, value, ROI, and marketing for realtors. They're killing it. I know realtors that are doing hundreds of millions of dollars, some of the best realtors in the country, and they're killing it with Instagram. So you're just seeing these different channels come and go. And then, TikTok is still a teenage thing, but you can see how quick they can go too. The president says we're going to turn off TikTok and boom. But I do think platforms, that in itself isn't going anywhere. We're going to see platforms as the marketing way going forward.
Cool.
Direct mail. I have to say a large portion to this day of my mailbox is filled with lenders marketing to me via direct mail. I get a lot.
Yeah, and it probably works. I mean, I actually don't think I've seen mail in like 3 years. My wife gets the mail and she goes through it, but I actually have not seen the mail in 5 years. And so mail's not a thing for me, but again, marketing is it's a numbers game, and so everything works. Telemarketing works, direct mail works, email marketing works, platform marketing works. It's a numbers game, and I don't think it's been like that for a long time here in America, and I don't think that's ever going to change.
Yeah. I'm thinking probably we're getting close to
We're getting close to the hour.
Yeah, this has been pretty awesome, and I think we've covered a lot. Any other things that you want to touch base on or share with the audience? Again, investors, mortgage folks, obviously, realtors, home services companies. Any other thoughts that you have on that you'd like to share?
Well, I'll just close out with the Mortgage Coach mission. When I came out of the meltdown, while I am a SaaS entrepreneur, software as a service entrepreneur, and I make money from loan officers or companies that buy our software, I changed my core metric to not how many members I have, which, by the way, it's important. It drives our P&L. It's an important metric. But I said, you know what, my number one metric is how many families, when they get in debt, do they click on a total cost analysis and they make their decision with a few more data points, go beyond rate, cost, and monthly payment, and go options over time with strategies to pay off their debt. And a little more data, easy to read. And coming out of the meltdown, I had less than 25,000 families a year that were getting, well, first of all, coming out of the meltdown, I didn't have a SaaS platform. I couldn't even count how many times a family clicked on it. But we became a link, and we live in this link economy now. I hit a link to get here. We apply for a loan with a link. We deliver a video with a link. We deliver advice with a link. We're going to do over 2 million families this year are going to, make it. So my mission is to change how people get into debt. So whether you're a loan officer or a realtor, you can still apply those principles. Like when you get into debt, what's the cost over the time you're likely to have it? Compare that to your options and look for strategies to get out of debt faster. And I do think, like, my legacy with Mortgage Coach as an entrepreneur, I'm for profit, so hopefully we make a lot of money. But I hope we also change how people get into debt in America. So I would just encourage you, some closing thoughts from me, write that down. A few more data points, it can be life-changing. Like all the time, a Mortgage Coach loan officer will show a family how to pay off their house 10 years earlier. What's that worth to you? It saves you hundreds in equity, hundreds in interest costs, and it creates financial freedom. So a little bit of data can change your life. And so that would be my closing thought, make better decisions with more data.
Dave,
that's great. Go ahead, Aaron.
What's the best way that they can follow your work, and what platforms, especially on social, should they be following?
Well, you can follow me on all social media. I mean, LinkedIn is called The Professional. You're a mortgage loan officer. I try to do quality posts. You can follow me on Facebook. I think I started using Instagram 2 weeks after it was founded, and I was jealous that I didn't come up with that idea because I was a photography minor and I love photos. But I mean, that's just personal stuff. if you are a loan officer and you're not in our Facebook group, Mortgage Coach Productivity Mastermind, you're losing money. And if you're a loan officer and you're not watching our YouTube channel, you should be replacing some of your Netflix with our Mortgage Coach YouTube channel. And then our website is
Mortgage Coach YouTube
mortgagecoach.com.
channel. Okay.
I will make
Good.
sure to link all of those on the site and on our YouTube. This goes up on YouTube, and I'll make sure to tag you. They just updated something that makes that a lot easier right in the headline. So
I can't wait to
I'll
check
make
it out.
I'll make it very easy. Well, thank you so much for your time, Dave. Really appreciate it.
Dave, really appreciate it.
Appreciate
Thanks
what
for
you guys
coming.
do, and I'm looking forward to seeing your new innovation.
All right.
Cool. All right.
Thank you for
Bye-bye.
listening to the Data Driven Real Estate Podcast. You can find show notes and links to some of the resources mentioned in the show at datadrivenrealestate.com. Click that Join the Community, and you'll be forwarded to the Property Radar community where you can ask questions about the current show and even see upcoming guests and ask questions there. We'd love to engage with you in the community, so check it out. Please don't forget to like, favorite, subscribe, and share on your favorite platform where you're listening to the show. It helps us out a great deal. Thanks for listening, and we'll see you next week.